Welcome back to another video. Now today what I do want to do is a bit of a regression analysis and explain to you exactly why we can expect the Federal Reserve to hike interest rates by 0.75% basis point, what it's going to do to the market, and what it means for the consumer in regards to the economy. Now, if you are new to the channel, a sub would be appreciated as I provide valuable educational content on a daily basis. And if you enjoy the video, please smash the like button for the YouTube algorithm. And as always, just let me know down in the comments below exactly what it is that you would like for me to cover in my next video. Now, you've probably noticed that the stock market opened with a lot of gaps there. The market didn't even went along with price action. It just boom open up with a gap. Now the reason why there's normally gaps in the stock market is that when a market gaps up, that means there were no traders willing to sell the market at that level, and then when the market gaps down, that means there was no traders willing to buy the market at that levels there as well. Sometimes it happens due to high fundamental economic events that happens over the weekend there as well. But what we are going to do is, my friend that asked me about the Fibonacci, you can just go through my YouTube channel. I've done a video on that before already, my friend. So we're going to use historical information, and we're going to look at what Powell mentioned in the past, and we're going to look at exactly as why we can see a 0.75% basis point hike there as well. The first thing that we do need to look at basically is that this is a post by Reuters. It reads here that the Federal Reserve embraces 50 basis point rate hikes in June, July to curb very high inflation. The problem with that is that they've done this at a time when the inflation was not as high. Now, one thing that we need to keep in mind is that the current the inflation is sky high. Okay, it's sky high. It says here the consumer price index in the US hits 291.5 points, bringing the annual inflation rate to 8.6% in May of 2022, which is the highest since 1981, compared to the market forecast of 8.3%. And if we go back to May month, last month, when after the Fed's hiked interest rates by 0.50 basis points, this is what Powell said. I want you to listen to it very carefully, and I wanted you to read it with an understanding. Now, this was last month. This was from Wall Street Journal, and you can see this was on May the 4th. This was when the interest rates was hiked at a 0.50% basis point, even before, after. Now, it says here, Powell said that we are on path to move our policy rate expeditiously to more normal levels. Okay, assuming that economic and financial conditions evolve in line with expectations. What that means basically is that things can only get back to normal if the inflation did not come through as high as it did of 8.6%. The market forecasted an 8.3%. Powell he says that the interest rate can only go back to normal if inflation gets under control. This is after a 50% basis point rate hike was introduced. This is also when the markets was this was also when after the 0.50% basis point was rate hike was anticipated, and this is also after he said that they will continue with a 0.50% basis point hike even as inflation slows down. Now, if you think about it in this way, if a 0.50% basis point was acceptable if inflation slows down, inflation did not slow down and actually went up to 8.6%, making it the highest that it's been since 1981, meaning that the Federal Reserve is going to have to hike the interest rates by at least 0.75% to curb inflation. It's not going to curb inflation overnight, but it's going to help down to slow inflation. And this is exactly why I think the Federal Reserve will hike interest rates by 0.75% tonight. Based on the fact that Jerome Powell said it himself, he said that the only way to bring down inflation is to be aggressive with interest rate hikes. And if the inflation doesn't slow down, they have to be more aggressive. That was the agreement they had with the central bank. They agreed that if inflation doesn't slow down, they're going to have to hike interest rates more aggressively. Now, guess what, ladies and gentlemen? The 0.50 was okay, but we're talking about aggressive because the CPI numbers was quite high, and that is exactly why they are going to hike interest rates by 0.75% tonight once again. Now, if you're sitting there in the US and you're wondering, okay, but what does this mean for the consumers? Remember that interest rate represents the cost of borrowing. So when the interest rates are raised by the Federal Reserve, money becomes more expensive to borrow. First, banks pay more to borrow money, but then they charge individuals and businesses more interest rates as well, which is why mortgage rates increases also. This is one reason mortgage payments have been rising so rapidly in 2022, even as housing markets and prices starts to slow down. Now, when interest rates goes higher, few people can afford homes and fewer businesses can invest in new factory and hire more workers. As a result, higher interest rates can slow down the growth rate of the economy overall while also curbing inflation. And what that means also, ladies and gentlemen, is that as businesses are not can't afford to invest in getting new people, it means that the unemployment rate is going up and the stock market's going down. And this isn't an issue affecting just the US, the people in America, right? Higher interest rates for the United States can have similar impacts on the global economy, whether by driving up borrowing costs or increasing the value of the dollar, which makes it more expensive to purchase US goods. But what it ultimately means for consumers is, and everyone else, will depend on whether the pace of inflation slows as much and as quickly as the Fed has been forecasting. Now, the Federal Reserve has been saying, we're going to tackle inflation. We're going to tackle inflation. My friend, inflation is at 8.6%. Are we still waiting for you to tackle inflation? Now, how and where the stock market's going to dump first? There, the US, the SNP500 will have to go down there first. And we could potentially see a liquidity grab first. We could potentially see the market just dive straight into it. Now, if you go down on lower time frames, you'll notice that the market has just been trading sideways, right? Now, the market has just been moving sideways since yesterday, and you can expect the same thing to come through today. Okay, just sideways. That's it. You can see that consolidation and start there. Now, yes, that is a sell-off, and these stocks are going to dump tonight, my friends. Dump number one. Sorry about that. Dump number two, and dump number three. You dump before the news is released. You just dump. That's it. Because the stock market is going to dump. Now, that is all from my side. Thank you for your time. And as always, cheers for years.